ever wonder what happens to your stock when a company files for bankruptcy? That's exactly what we're going to find out today on this episode. Hi everyone, my name is Jose and welcome back to the IPO Nerd, the best place to learn about new companies going public and how to invest in them. As you probably heard by now, Revlon has filed for Chapter 11. This company has been around for almost 100 years. So that got me thinking, it got me curious and wondering what happens to my stocks when a company files for bankruptcy. I did a poll on my Twitter and a lot of you are wondering the same thing. By the way, follow me on Twitter for the latest news and new content. Well, the answer, it depends. It depends on which type of bankruptcy the company files for. If the company files for a Chapter 11 bankruptcy protection, it means that the company is asking for a chance to reorganize and recover. If the company files for Chapter 7, then your company's dead, and so are your shares. So if you own any Revlon, the company's not completely dead just yet. As a matter of fact, the company is expecting to receive $575 million to continue its day-to-day operation through the DIP loan. A DIP loan, or debtor in possession, is a special kind of financing meant for companies that are in bankruptcy. The DIP lenders take a senior position in the company and the possession of the company assets ahead of previous lenders. There's still a chance that Revlon will be able to reorganize and eventually pay back some of their debt. If you think about it, a few years back, the rental company Hertz had the same problem. It was in the same position due to the lack of customers during the pandemic. After only 13 months, the company was able to recover by selling more than 200,000 vehicles and even added some Teslas to their fleet. Okay, so let's say that the company you have stock in does not file for Chapter 11, or they file for Chapter 11 but are not able to recover. Well, then your stock is defunct, and you may be at best get a portion of their value back whenever the assets are diluted. Once a company is in liquidation, the law determines how the assets are diluted and distributed. First in line are secured creditors. Second in line are unsecured claims by the Federal Reserve Bank. Third in line would be any unsecured claims up to $10,000 by an individual or corporation. And all the way down at the bottom of the list, after all the secure and unsecured claims are paid off, then are the stockholders and shareholders like you and I. Bankruptcy can happen to anyone at any time. When it does happen, it's bad for investors, it's bad for the company, and it's bad for the economy. No one is immune to bankruptcy. However, there are ways that the company can avoid it. By making sure that their level of debt is not far greater than the level of cash flow, the company can avoid bankruptcy most of the times. And that's why it's important to look at a company's balance sheet. But that's a topic for another video. I hope I answered all of your questions on this video. Please make sure that you subscribe and share it with your friends. As always, make sure you take care of yourselves. And I'll see you soon.
I bring up the pain, Rick service the main. I make the market rain like acid rain. An investing channel you ever know, ya. I think you'll blow your house, your money, leave you broke, son.